Hi, good evening, everyone, and a warm welcome to our LLF Let's Learn Futures webinar series. We are thrilled to have each of you here with us today. And before we begin, please confirm in the chat box by typing yes 111 or share an emoticon if you can hear me clearly. I repeat, if you're able to hear my voice clearly, please type in 111, yes, or share an emoticon if you are able to hear my voice clearly. All right, great. Thank you very much. Now, today's Let's Learn Futures webinar topic is Mastering Risk Management in Futures Trading, the strategies to profit and protect. Now, this LRF webinar series is proudly brought to you by Bursa Malaysia in collaboration with Excellent. I'm CY Saw. I will be the moderator and speaker for today's session. I will be sharing with you about why risk management is important when it comes to futures trading. What are the essential things you must equip yourself in order to manage risk effectively, and some of a few popular techniques to protect your trading account. I see more people have just joined this webinar room. Welcome. Once more, before we begin, let's do one final sound check. Please type in 222. Yes, or give us a thumbs up in the chat box if you can hear me clearly. And if needed, please adjust your volume settings to ensure optimal sound quality. And to ensure you have the smoothest and highest quality video experience, I highly recommend turning off your video camera during the session, as this will help optimize the internet bandwidth usage, prevent interruptions, and ensure an optimal learning experience for everyone. And today's session will be divided into two parts. The first part, I will present my sharing. Following that, we will be having a Q&A session where you can ask questions related to today's webinar topic. So I believe you already know where to find the Q&A box. All you need to do is go to somewhere on the lower right. There is a 3 dots there. Click onto it. Then find a green icon called Slido Q&A or polling. All right, so click on it. Then there is where you are able to find a box to type in your questions. So please note that in the chat box there might be a high volume of messages, so it may be challenging for me to spot your questions if you don't use Slido for Q&A. So feel free to type your questions in Slido box at any time during the session. As this is the LRF Let's Learn Futures webinar series brought to you by Bursa Malaysia, we have a lineup of exciting topics ahead, helping you deepen your understanding of futures trading. Every Tuesday, we will host a new webinar topic in this series featuring sessions in English, Malay, and Mandarin. So you can see here, our next Tuesday session is Global Vegetable Oil Market Outlook. So for those of you who are trading the FCPO contract or who are interested to know a little bit more about the fundamental analysis or the market outlook that is related to FCPO, then you are most welcome to register yourself in the 20th of May session. All right, so every Tuesday, our panel of speakers and experts will share their valuable knowledge, insights, and practical strategies related to futures trading. We have many content-packed and informative topics lined up, with more being added regularly. So if you're interested to enhance your knowledge and skills in futures trading, simply scan this QR code, or you can find the link in your chat box there. And don't forget to add this session once you have registered to your calendar, so you won't miss any of them. Besides that, we also have the LRF online workshop. Now, this online workshop is specially designed for those of you who are still new to futures trading, or if you're still unfamiliarized in futures market yet. Because in this workshop, we cover a full set of beginner's knowledge in futures trading. It's a step-by-step guide to help you kickstart your first futures contract. Each session is 3 hours long. And the upcoming LRF online workshop session is this Saturday, which will be conducted in English language. The seat is almost full, so you need to quickly register yourself before we close the registration. And the next upcoming online workshop will be, you got to wait until next month already, okay? And it's also conducted in English. So if you are new to futures trading and would like to learn more, you can register for these online workshops. They are entirely free and fully sponsored by Bursa Malaysia. And Please note that the attendance is limited to the first 50 online participants, so be sure to grab your seats quickly. Now, I believe you are quite familiarized with me already. My name is Saw Chun Yan. You can just call me by my initial as CY. So just a brief introduction for those of you who haven't seen me before. So first and foremost, my background is in finance and investment. I started my career in the capital market, specifically involving in trading and investment management. So I have been trading across different multiple time frames, from intraday scalping to short-term trading, long-term value investing, and so on. And yes, I do specialize in technical analysis because I'm a chartered market technician. And not only that, I'm also specialized in trading psychology. So besides that, I'm also involved in hedging and risk management consultation, where I consult with companies to help them manage and hedge their commodities price risk and other financial risk. I'm also a trainer, providing upskilling training in different areas, especially in soft skills like leadership and communication and so on. So without further ado, let's begin with our session for today. Now, before we begin, I would like to get a quick sense of who is here so that I can better tailor my sharing for today. And don't worry, I'm not going to ask whether if you are brand new to trading or already have years of trading experience. That is not the focus for today. Now, what I'm curious to know is how many of you here, if you have been facing problems or challenges with trading losses, you can type in 1 in the chat box here. Okay. Now, what do I mean by trading losses or challenges here is that, whether it's knowing where to cut your losses, how to actually do it, or just dealing with emotional roller coaster that comes with it. So if you are facing with any of these challenges, go ahead, type in 1 in the chat box so that I know, and also to confirm that you are at the right place, right time also. All right. So I see plenty of you are actually typing 1 here. All right. Because admitting that facing these challenges is actually the first step to manage risk, and there is no shame to it. I believe all good traders or all experienced traders, they have been there. We have all been there, and that is exactly all of you are here today. And after spending years running webinars and teaching about investing and trading, there's a pattern that I see over again and again. Whenever we host a session on topics like trading strategies, technical analysis, indicators, chart patterns, anything that is related to, helping traders to make profit, right? Usually the environment is high and many people would actually turn up. Everyone is excited. However, when it comes to topic like risk management or even portfolio management, how to manage your overall trading risk, it's the opposite scenario. And that tells us something really, really important. It tells us that most traders, maybe you might not even realizing it, is that they tend to overlook risk management. They underestimate just how critical it is to manage their risk in trading, and often there is this quiet, some sort of what we call as overconfidence in their ability to outsmart the market. But here's the truth. It's not your best trade that defines your long-term success. It's about, how well you manage your worst trades. You can have the most powerful and profitable trading strategy in the world. But if your risk management is weak, if your defense is weak, a few bad trades can wipe out, months and even years of your hard work and progress. And that right there is exactly why I have to talk about this topic today. Not because it's the most exciting, flashy, or popular topic, but because it's one of the most important thing that determines whether you are able to sustain in trading over the long run. Because if we keep ignoring risk management, our trading journey will not be sustained for long. And you don't need another indicator. You don't need a holy grail strategy. What you need is a solid foundation that help you stay in the trading game long enough to let you let your trading edge actually play out over the long run. And that foundation is actually the risk management. All right. Now, before we begin, I would like to give you a quick disclaimer. Now, this presentation is intended solely for educational purposes, and it should not be considered as investment advice or a recommendation to buy or sell futures contract. And throughout today's webinar, I will be sharing with you some risk management strategies that can be applied within the context of futures trading. And what I shared what I will be covering today is intended as a set of reference point for you to enhance your understanding and also refine your approach as well as your attitude towards trading. And with that being said, my hope for today is that today's session will help you broaden your perspective and also deepen your knowledge, especially in the area of risk management, so that you are able to know how to make your trading journey more sustainable. Now, your presence today says a lot. It shows your commitment in improving your trading performance, and it also shows that you are more or less understand the importance of risk management. So I will be sharing some practical insights as well as some actionable strategies. So no matter where you are on your trading journey, you will walk away with some valuable knowledge that you can apply right away. So I will be dividing today's topic into 4 key areas on risk management. So the first topic, understanding essential risks in futures trading. I will briefly go through what are the key risks you need to monitor in futures trading, and the most importantly, the mindset of managing risk. Secondly, I will share with you when it comes to risk management, why it is still important to emphasize on your trading strategies. The third topic, there are at least 7 ways you can measure how you can do your cut loss and protect your capital, so you can wait for another trading opportunity for you to strike. And lastly, we will explore the final ingredient of risk management, which are money management and position sizing. When your trading account size grow, when you have the ability to trade more futures contract, then you must master this aspect of risk management, which is money management and position sizing, so that you are able to scale up your trading. By the end of this webinar, you will have a deeper understanding of risk management, and you will know what are the tools and techniques available for you to manage trading risk effectively. Now let's go into the first topic, understanding the essential risk in futures trading. What key risk you need to monitor and what kind of mindset you need to have. Now the first 2 topics is actually way more important than topic 3 on how you do your trading, because once you have the right mindset, once you understand the importance of risk management, once you have a big why, how you're going to do it will become quite easy. Now, first thing, why risk management is important in trading. Now, in our everyday life, and especially if you're doing trading, most people ignore risk until it's starting, risks is actually staring them in the face. Okay, most people don't think about risk until something bad happens. So it's a bit like no one thinks about buying insurance until their house gets flooded or gets fired. Right. So it's also like no one really starts eating healthy until they diagnosed with major illnesses or even disease. And in trading, it's the same thing as well. We often don't truly grasp the importance of risk management until we are already taken a painful hit, which is having a huge losses. And there's a quote I really believe in, is that it's only after disaster strikes that we start to prepare for the next one. Okay, but the problem in trading is waiting until after a big loss happen is oftentimes too late already. You have already suffered a huge loss. What has been done, it's already done there. Okay, damage has already happened. So here is what usually happens when things are going well. People usually take bigger and bigger risk. They start to think that their wins are all because of their skills, okay, not luck. They get comfortable, they get confident, and maybe just a little bit too overconfident. And then when one bad trade or a few bad trade wipes out their weeks or months of progress in earning all those profits, and only then they started to say something like, maybe I shouldn't manage my risk better. Maybe I should have cut my losses earlier. Maybe I should have trade smaller, and so on. So by that time, the damage is already done. Okay, we cannot undone what has already happened, right? So this is especially true in futures trading, where leverage and volatility can turn a small mistake into a major losses very quickly. So that's why I want to be crystal clear about one thing. Okay, good risk management is not about reacting to bad events. It's about preventing them, or at least minimizing the negative impact. All right. Now, here's something else I really want to emphasize. Risk management is not just about tools and rules. Now, I understand many of you here, coming in this webinar, you want to quickly learn about how are you going to manage risk, right? You want to learn what are the tools, what are the risk management rules that you can use so that you can immediately applying it. Now, one thing that you need to realize is that it's not just about setting a stop loss. It's not just about position sizing. It's not just about, ticking off or crossing things in your checklist. All right. Now, don't get me wrong here, because those things they are important. They are part of risk management and your trading process, but they are not the whole picture, because the real risk management goes way deeper. Now, it's not just about what you do, it's actually also about how you think, okay? Your mindset, and it's also an attitude, because this discipline can influence every single decision you make as a trader. So it's a voice in your head that says like something like, this trading setup looks good, and it's a good trading opportunity, but whether is it worth the risk or not? Sometimes you might be, another voice coming in your head is that I am on a winning streak, but am I getting overconfident? The market looks tempting, but is it really the right time for me to enter? So this is actually the part most traders miss. So they treat risk management like a seat belt they fasten when they think they might crash, okay, instead of making it part of the way they drive every single day. So it's like, when you're in your car, immediately you put on your seatbelt, right? You don't wait for a crash to happen. You don't wait for accident to happen. Then only then you put your seatbelt. So same thing goes with trading, is that you need to first think of risk first. You need to be an autopilot. First thing is manage your risk first, then only think of how to make profit. So, and for those traders who last and survive in the market for long, are the ones who make it through the market ups and down cycles. Well, they don't just use risk management, okay? They live through it, okay? They are the professional risk management manager, I would say. Now, so what does it mean by having the right attitude towards risk really look like? Now, let me break it down into these, at least these four things. First thing is that you need to respect uncertainty. Why? Because no trade is guaranteed ever, okay? Even the best looking trading setup, or even the best trading strategies, they can fail. And that's why great traders, they oftentimes they stay humble. They don't assume, they always prepare for the worst. Number two, you need to prioritize your survival over quick wins. Okay, your first job as a trader is not to win big. Okay, it's for you to stay in the game. Now, if you lose your capital, you don't have opportunity to continue to trade anymore. Am I right? So protecting your account is actually considered the four most important thing. Now, thirdly, you need to think defense first, okay? Offense comes second. Now, the best traders think like world-class athletes. Now, I believe some of you are quite familiar with footballs, right? It's just like football games. Now, whether is it, those football stars like Lionel Messi, Cristiano Ronaldo, David Beckham, or even Michael Jordan in basketball, okay? They all knew that in order to win games, it's not just by scoring goals, but also preventing mistakes. Those football or basketball stars, they are famous not because they are good in scoring. Okay, their team is also very good in defense. Only then they have the opportunity to score. Okay, does that make sense? Now, same thing goes for trading. The same principle applies. You need to ask yourself, what could go wrong in this trade? What would be my biggest loss if I make a mistake? How much could I make, or how much could I lose? Okay, those are the things that you need to think of your defense first, then only think of profit. All right. And lastly, you need to take responsibility for your trade. Okay, this is actually a very big one. Yeah, we don't blame the market. You don't blame the news. You don't blame on bad luck. You don't blame on whoever world leaders who make whatever news that change the market. Okay, every single trade is your own decision, and so is the risk that comes together with it. By owning the responsibility is actually how you grow as a trader. And with this mindset, it's not just only for trading, it can also be applied with your daily life as well. Okay, now think about it as being a responsible driver. They don't just count on seat belts, right? They drive safely, they drive defensively, they anticipate danger, even when the cloud is clear. Or for a successful entrepreneur, they take risk for sure, but they also plan for setbacks. They stay calm under pressure. They don't bet it all on hope. So trading is the same thing. Risk management is not something that you do after you open a trade. It's something that you think before you even start the trade. All right, I repeat again. Risk management is something that you have to think of already before you even start or initiate a trade. So here's the key takeaway I want you to remember is that mastering risk management is not about learning a lot of different techniques. Okay, it's about being the kind of trader who always thinks about risk first. Okay, when that mindset becomes who you are, so that's when consistent positive results become possible for you. Okay, now before you learn any risk management techniques or tools, I want you to adopt this very important mindset first. So let's talk about something that ties everything together, and that is this what we call as the risk-based thinking. So what is risk-based thinking? It is a form of thinking that is a proactive mindset. Okay, proactive means you have to initiate it by yourself. You don't just wait for things to happen passively. It also means that you need to assess the risk before you make any trading decision, not waiting until something goes wrong to react. Okay, so every time when you trade, you need to adopt this risk-based thinking before you even initiate a position. Now, it's about consistently asking yourself, what could go wrong? How big could the downside be? Am I truly prepared for it or not? And in futures trading, this becomes absolutely essential. You are dealing with leverage. You are dealing with market volatility. So before you place a trade, risk-based thinking means you imagine the worst case scenario. You size your position with intention. You take care of your position. You set your stop loss with discipline. You cap your exposure, not based on emotion, but based on a good trading plan. And this mindset is not just only limited to trading. Okay, same thing. We oftentimes apply risk-based thinking in our daily lives as well, whether we realize it or not. So, for example, driving a car, you wear a seatbelt not because you expect a crash, right? But because if crash were to happen, the consequences can be very unimaginable. So, which is why you put on your seatbelt. Same thing goes with buying insurance in our life, whether is it life insurance, health insurance, car, or even home insurance. Well, you might not use it every year. Okay, you hope that you won't use it anyway, right? But you pay for it anyway because you understand what's at stake if the unexpected happens. Another example is crossing the road. You look at both ways. even if the road is usually empty. Because all it takes is actually one car come out of a sudden, just only one time accident happens, and our life is gone. So trading is no different. Just because the market seems calm, or just because the trading opportunity seems to be so clear, now that doesn't mean that risk is not there. Okay, the key for us is for us to constantly prepare for the unexpected every single time. Don't wait for crash to happen. Don't wait for losses or even accident to happen in order for us to learn the lesson. Okay, so good trading is not just about making profits. It's also about surviving losses, because if you can survive, if you can stay in the game, and if you can stay in the game, your strategies will take time to work, and your skills will have time for you to grow as well. So always adopt this risk-based thinking in your trading. Now, before we wrap it out, there's one more distinction that I want to make here, is that futures trading is not the same as stock trading, and treating it like stock trading, right, can be a costly mistake. Now, futures trading carries its own set of risks, and if you're not aware of that, you are playing a dangerous game. Okay, so let's break them down. Is that futures trading, we have leverage risk, because you're trading with leverage. You are actually controlling positions many times larger than your actual margin. So that means a small market move can lead to big gains or big losses. So the same leverage that amplifies your profit can also amplify risk and wipe you out quite fast if you're not careful with it. Secondly is the market volatility is also a risk. Futures market moves pretty fast. Prices can swing quite wildly in just a matter of minutes, sometimes in even seconds. So without a solid risk control, it's easy to get caught on the wrong side whenever there's a sudden movement, especially during news events or low liquidity periods. And thirdly, margin call risk. Now, if your trade move against you and your account falls below the required maintenance margin, your broker can issue a margin call, forcing you to deposit more funds or close your position. And they can actually liquidate your position automatically if you don't respond quick enough. Okay, and this is actually not optional. And lastly is the settlement and expiration risk. So unlike stocks, futures contracts have expiration dates. And if you're not aware of rollovers or settlement terms or even delivery risk, you may end up in positions you never intend to hold. Okay, if you ignore all of these futures market mechanism, it can lead to unexpected losses and very bad consequences. So here's the bottom line, is that you need to understand the rules of the game in futures trading. Understanding the market structure for futures market, understanding the unique risk in futures, and manage it. All right. Now, in futures trading, active risk management is not negotiable. You cannot just buy and hold. Okay, you cannot just buy and forget about it, and not with the kind of leverage and volatility that especially in today's market that we are dealing with. Unlike stock market, where you might when the market is down, you can buy over a dip and hold it for months or years. In futures trading, you need to manage your risk actively. So that's why you must constantly monitor your positions. You need to have a clear stop losses and be ready to adjust or even cut your losses as the market moves. You must react fast also, and hesitation can cost you quite greatly. And let's talk about exit. In futures, you need a plan before you even enter a trade. Okay, you need to have an exit plan before you even enter a trade. Knowing exactly where you are going to take profit, knowing exactly where you will cut your losses. Because if you're hoping that the market is going to turn around, it's actually not a strategy. Okay, hoping is not a strategy. That is how most trading accounts actually blow out, because they just hope. And finally, position sizing and risk management. Okay, later on in topic 4, I will talk a little bit more about position sizing and money management. So the bottom line is that without active risk management, even the good trades can become a disaster. All right. Now, here's another common mistake I see all the time. People think that risk management is something separate from their trading strategy, but in fact, it's not. Trading strategy is actually your first line of defense. Now, I would like you to have a look at this picture. Okay, I'm going to give you 20 seconds to look at this. What message do you get from this message? If you get some message from this, can you please type in some keywords or short sentences in the chat box? I would like to see, what is your interpretation that you get from this image? You're welcome to type your responses here in the chat box. Because different people have different interpretations, so I would like to see how do you actually interpret on that. All right, I see some responses here. We have overtrading, we have missing the point, we have gamble. All right, we have target, missing target badly despite many darts thrown. Okay, maybe some of you are still typing, that's fine. Now, if you look at this image, right, I think there are at least 5 to 6 messages depending on the context of how you would want to emphasize or how you want to interpret it. But here, let's relate back to this topic is that there are at least 3 key messages here that I want to highlight to you, okay? 3 key messages here. Now, number 1, having many arrows does not mean that you can just simply shoot without skills, okay? So same thing as in trading is that just because you have a lot of money, you have a lot of capital in your trading account, you have tools or even multiple trading strategies, does not mean that you can just simply use them, okay? You would waste a lot of unnecessary losses. Without skills, without discipline, or even without precision, your resources would get wasted. So in other words, you are losing money. Okay. Now, the second interpretation is that shooting arrows randomly without proper aiming can lead to consistent failure. Okay, this is what we call as having poor strategy. So it's like you are training to learning how to shoot, but if your shooting skills are very poor, you did not polish up your skills. It's like jumping into a trade without having a clear trading plan or trading strategy. It's like shooting in the dark. You will miss more often than you hit, and the losses can you can, as this picture, you can shoot a lot of arrows, but all ended up none of it hits the target. So again, you will be losing your money quite pretty quickly. And the third message, just shooting a lot arrows does not guarantee that you will hit your goal. Now, a lot of people would tend to do this unconsciously, okay? Because if you have quantity without accuracy, it's also considered not a good thing in trading. So when we talk about trading, it's like people tend to overtrade. Having more trades does not mean you would have more profits, okay? Overtrading without accuracy, it's also another fast road for you to get, physically burnout, emotionally burnout. Your trading capital would burn out, and ultimately you will blow your account very soon. So remember this, it's not about how many trades that you take. It's not about how much money that you have in your account. It's about how well you take each and every trade, okay? You need to, when you do your trading, you need to trade with clarity, you need to trade with purpose, and you also need to make sure that the risk is actually under control, okay? So you can see a lot of things that we need to emphasize on risk management before we even go into the strategies or even techniques. You need to get the mindset, your psychology right first. Now, why trading strategies are your first line of defense? Number 1, a strategy is actually your risk filter. Because if you trade without strategy, it's like trying to cross a battlefield blindfolded. Every decision, like enter exit or even cut loss becomes random and emotionally driven. So a good trading strategy can actually act as a filter. It filters out, it screens out all of those lousy, low quality trades. It only allows high probability setups to pass through. So this natural filtering process automatically reduces the number of bad risk you take, okay, even before thinking about stop loss or even position sizing. Okay, this is number one. So the key point is the first step to lower your risk is not to try to keep cutting losses, because if you select better trades from the beginning, already you can reduce a lot of risk. Number two, smart entries naturally lower your risk from the start. A smart trading strategy lowers your risk. You focus on entering trades only when odds are actually in your favor, when you are actually having a trading edge. So for example, entering trades near key levels like support, resistance, breakouts, or even pullbacks, not in the middle of volatility or not in the middle of chaos. So when you are entering smartly, your stop loss can be tighter because you are close to a good point there. Okay, your potential reward is also larger compared to your risk. Bad entries will force you to use bad entries can trigger your stop loss even when you put a wider stops. Okay, bigger risk, and leaves you uh, cut your losses and get out of the trade very quickly. Now, so imagine this. It doesn't really matter how many arrows you have if you're actually shooting the wrong way, right? A trader with bad entry, it's already losing. So even before the market moves, smart entries actually will be able to give you a good, better shots. So it's like you are position yourself closer to the target. You are position yourself for a higher chances for success. So the key point here is that good trading starts with good entries. The better you enter, the less work risk management has to do, that you need to cut your losses later on. All right. Now, number three, a strategy sets a clear boundaries. Now, number three, strategy sets a clear boundary, because a trading strategy is not about finding entries. It also sets boundaries for your behaviors. When you can enter, when you must exit, how much you can risk, and what traits that you should completely avoid, because these boundaries protecting you from yourself. Okay, because when it comes to trading, a lot of emotional impulses, like chasing trades because you are bored, over trading when you are having a streak of winning, refusing to cut the losses because you hope that the market will come back. So without setting a clear boundaries, you are actually considered quite naked in the market. You are vulnerable to your worst instinct. Okay, so a strong, clear strategy actually saves you from your biggest enemy, which is actually yourself. Now, number four is that consistency reduces emotional risk, because if you trade without strategy, it feels exciting at first. Am I right? Because every trade feels like an opportunity, but this kind of roller coaster, it's actually quite deadly to your capital. When you have a strategy, you know exactly what you're looking for. You know when you are right, and you also know when you are wrong. You don't have to uh, guess about the market. You don't have to take unnecessary stress or pressure. So over time, when you follow a strategy that is built based on discipline and resilience, you trust your process, you focus on your good trading execution, and not based on the outcome of all of those any single trades. Okay, so always focus on consistency here, because consistency always beats randomness. If you are trading randomly, your results will be very random. Okay, if you trade with good consistency, your over the long run, your strategy will dictate whether you are able to win over the long run. Okay, now lastly is that you control risk at the planning stage. not after you enter a trade. Okay, the most important risk management decision happens before you place a trade. Okay, you control your trade selection. Okay, you select high probability trade setups. You decide your trading size first based on your how much risk that you're willing to take, how much money that you have in your account, because your first entry is always the most logical and strategic entry. Okay, and also because of that, your first entry, you also have already planned where you are going to exit, where you are going to take your losses. So if you control all of these at the planning stage, even if the market surprises you, you are able to control your losses quite easily. Okay, so here you need to please take note all of these 5 key points. Now, to be successful in trading, you need to take a proactive approach, and here's how you can build a solid foundation for your trading journey. So number one, you need to develop a clear written trading plan. Now, for all of these 5 points, right, I'm not going to go in so in depth because I believe there are plenty of topics on trading strategies also talk about quite similar thing. Number two, you need to focus on high probability setups. You don't chase on every opportunity. Only take trades when the probability of success is high based on your trading system, based on your trading setup, and don't try to overanalyze. Thirdly, you need to backtest your trading strategies and system before risking your own real money. Because when you backtest your trading system and your trading strategies, you know whether your trading system works or not. Number four, you need to define your risk before entering any trade, because knowing exactly what you're willing to lose before you enter a trade, you can set your risk upfront. You can avoid avoid a lot of emotional decisions and unexpected surprises. And lastly, always use position sizing based on the risk that you have. Okay, you need to also look at how much money in your trading account so that you don't get wiped out all completely. And always remember, trading it's about consistency, preparation, and discipline. So with a clear plan in place, you're actually setting yourself up for long-term success. Okay, not just only hoping for the best trade. Now, so far we have already covered the philosophy of risk management, why it's essential, the mindset you need to adopt, and how your trading strategy itself plays a crucial role in managing risk. Now let's get into the more tactical side of things, which is cutting losses. Now this is where many traders struggle, but it's also where the good things happen. Managing your losses well is different. It's the makes a whole lot of difference between surviving and thriving in the market. Okay, now let's begin with cut loss strategies. Do you know there are many ways to cut your losses? So here there are at least 7 ways. Okay, I put it in categorize it. Okay, we have fixed dollar, fixed percentage, technical base, volatility base, fundamental base, and time base, and also trading stop loss. Now, out of these 7 ways of cut loss strategies, how many strategies that you are currently using or practicing in your trading right now? Okay, if you're practicing three types of cut loss, you can type in 3 in the chat box. If you are just practicing one only, you can also just type in 1 in the chat box, so that at least I know you are doing some form of risk management. Okay, can you share with us how many strategies or cut loss strategies that you are doing? Okay, I see we have 1, 2, 3. Okay, most of you using 2. Okay, very good. Some are using 4. All right. So most of you are actually using I see on average would be about 2 strategies. Okay, now all of these methods are how you measure the losses you are willing to take. Okay, it's just only a measurement. Now, before I enter into each and every trade, each and every strategies, let me share with you how to set your cut loss first, okay? Because how you set your cut loss is the same thing. Because different strategies, it's just only a measurement, how you measure your how much losses you are going to take, and then you need to execute your cut loss. All right. So first thing is that you need to determine your risk tolerance level. What is the maximum amount of money you are willing to lose in a particular trade? This is the first step to protect yourself, knowing your boundaries before you enter. Secondly, you need to set the cut loss amount. So once you know your risk tolerance, deciding how much you're willing to lose, now this sets the foundation for your stop loss level. You can use any of the 7 ways I'm going to share with you later to calculate how much you're willing to lose. Now, thirdly, you need to calculate the cut loss price level, okay? Based on your risk tolerance and your position size, you need to calculate the price level at which you will cut your losses. Now, this is where you will exit if the trade goes against you. Okay, later we will be running through some examples on that. Number 4, once you are able to identify, if the price hits your cut loss price level, you need to execute your stop loss order. Whether is it, you use a stop order or execute a limit order, market order, that's fine. You just need to get out of your trade as soon as possible. Okay, now don't let your emotions interfere with your plan. Your stop loss is there to protect you, okay, not something for you to second guess. And number 5, you need to stick to your plan. Once your stop loss is set, don't move it, okay, unless the market condition change significantly. Always stick to your plan regardless of how emotional the market or how your position gets. Now, for those of you who are still very new to trading, please always stick to your trading plan, okay? Don't ever move your stop loss, okay? Because why? You still need to practice number 6, which is maintaining your discipline. Now, I know that it's quite tempting to move your stop loss around or even try to ignore it, because especially when the trade is not going your way. But staying disciplined is actually very essential. You need to trust your process and stick to your rules. Okay, cutting losses is about having a plan and sticking to it. The market will oftentimes test your discipline. Okay, trust me on this. The market will test your discipline. But managing your losses effectively is one of the most important habits you can build as a trader. All right. So how to set your cut loss is that, again, very simple. It's exactly how you take your profit. It's exactly the same how you close your position. Okay, that is how you cut your losses. There is no unique or special orders that you need to do. Okay, let me repeat again. How to exit your trade is exactly the same as how you take profit, whether you use a limit order or market order or even stop order. Okay, it's the same thing. It's just that when you cut your losses, it's the time, instead of seeing that your account having a profit, but this time you are seeing that you are losing money. Okay, you need to get out of the trade. Now let's start with the first basic cut loss strategy, the fixed dollar approach. Now this is the easiest and commonly used method because of its simplicity. Okay, so a dollar-based cut loss strategy involves setting a fixed dollar amount as the maximum losses that you're willing to take on a single trade. So once this loss level is actually reached, you close your position to prevent further loss. So actually here is how you are going to do. So for example, if you're willing to take a $500 losses on this trade, so let's say we are doing a FKLI trade, so $500 divided by $50 for FKLI per point. So the maximum point that you are going to lose, it's actually 10 points. So if the market is going against you by 10 points, let's say you enter a price at the long position at 1,600. So you need to set a cut loss at 1,950. So which is 1,006 minus 10 points. So you can set it, you can do this cut loss manually, or you can use a stop order. All right. So same thing goes for FCPO. If you're willing to lose $500 per trade, so $500 divided by $25 per metric ton. So here the maximum amount of loss the market going against you is 20 points. So once you lose 20 points, you need to get out of your trade. So for example, if entry price is 3,800, a long position. So if your loss reaches 3,780 price level, you need to get out of your trade immediately. Okay, never ever second guess. Now, here are the pros and cons of fixed dollar approach. Is that fixed dollar, it's very easy to apply. It's simplicity. Now, of course, this allows you to prevent large losses because when you automatically set this loss, it automatically exceeds the trade before losses become too large. And it's easy to calculate anyway. Okay, it reduces emotional trading. Now, the disadvantage is that market fluctuations, especially in during volatile markets, your losses might be triggered very easily due to the temporary price movements, causing you to exit a trade quite prematurely. And sometimes the actual exit price might be very different from the stop loss price due to slippage, okay, because due to the market is moving too fast. So you might exit at a price that is not favorable. So this is a straightforward cut loss method that helps you protect your capital and maintain discipline in your trading practice. So I believe most of you are using a fixed dollar method. Now the second method is actually using fixed percentage method. You set a fixed percentage of your position value that you are willing to lose. So for example, if you're willing to lose 2% on this trade, so let us use a quick simple example is that if your trading account is 20,000, how you are going to apply this 2% rule. So let's start with FKLI first. So for FKLI, 2% loss. So if you are using percentage, fixed percentage, right, we always measure against your trading account. Okay, so 20,000 out of this 2%, it is $400 of losses. So you need to take $400 divided by $50 per point. So if you lose 8 points in FKLI, you need to get out of that trade. Okay, whether is it a long position or a short position. So this is a fixed percentage. Similarly, for FCPO, you measure based on your trading account, how much you have in your trading account. So 20,000 times 2%, so you're willing to lose $400. So $400 divided by $25 per metric ton. So if FCPO is against you by 16 points, you need to get out of your trade immediately. So you can see fixed percentage, it's a two-step way. So you need to, convert your percentage into dollar form, and then from dollar form, you need to reverse calculate to see how many points, what is the price level that you are going to exit your trade. Now, a quick question for you. Can you use this 2% rule to cut loss in futures trading or not? Okay, if you believe it's a yes, you can type in yes in your chat box. If you believe it's a no, you can type in no in the chat box. Now, I believe a lot of you, if you are reading books, watching videos, or reading a lot of articles, you might be reading 1% rule, 2% rule, 3% rule. Some even uses 5% rule. Okay, so I would like to also highlight out what is the cons behind this. Okay, there are conditions for you to use this 2% rule, okay, so that you understand what you're actually using, because fixed percentage is also quite common where a lot of traders will be using. Okay, so I see a lot of you typing in yes. Okay, some of you put whether 1% is too small or not. Okay, all right, let's look at this table here. Now, how you read this table, it's actually very simple. I have already convert the 2% in terms of dollar, and I also calculate in terms of points. Now, so just now, the example I gave you was 20,000 for 2%, right? So for FKLI, 2%, if your trading account is 20,000, so for 2%, 20,000 account is you are willing to risk $400 per trade, and converting to point, it would be 8 points in FKLI. If you're for a 2%, in a 50,000 trading account. So which means you are willing to take 1,000 ringgit of losses. So if we convert to points, it will be $20. Okay, same goes with $100,000. If we take 2% loss, so that would be 2,000 ringgit of losses. Convert back to point would be $40, 40 points in FKLI. Okay, so here if you look at this, and this is actually calculated based on one contract calculation only. Okay, so 20, which means 20,000 to trade one contract, $50,000 in your account to trade one contract, $100,000 account to trade one contract. Okay, this is based on one contract only. So if you look at in terms of points, right, given especially when the market is very, very volatile, it will seem that your cut loss level can be too narrow already. So which means during a volatile market environment, it can be easily triggered. Okay, so because you are trading futures, the minimum amount of contract is one contract. You are not able to trade 0.5 contract or 0.1 contract. Okay, the minimum amount is actually one contract. So if you do all of these reverse calculation to see how much in terms of dollar and points that you're willing to lose, then you will be able to see that hey, this 1% rule or 2% rule might not be applicable anymore. Okay, even though I understand, you know, even with $50 trading account, right, you are able to trade, let's say 5 or even 6 contracts. But if you look at one contract in terms of points only, right, it seems like the cut loss can be too narrow and easily triggered. So there is a condition for you to use this fixed percentage. Now the good thing is that if you use fixed percentage, it gives you a consistency based on your trading account size. Because if your trading account size grow, it will be based on the 2% of the big account. If your trading keep having losses, right, your percentage will become, you know, following the new updated trading account size. So this gives you a consistent and systematic approach to manage risk across all trades. And good thing is that the percentage can be adjusted based on the volatility of the market. It minimizes large losses, but the cons is that during volatile markets, you know, price swings can trigger your stop loss order quite easily. And if you're trying to use percentage, a fixed percentage approach, it is not usually applicable for small account size. Okay, just now I've already highlighted to you on the table just now, right? So now you are able to see that, you know, if you are trying to do 1% or even 2%, right, your cut loss can seem to be very, very narrow and very easily hit. So if your account size, for example, if it is 100,000 or more than 100,000, then it is easier for you to apply a fixed percentage approach. So which means for if you are intent to use this method, don't worry. Probably someday, okay, when your account size keeps growing larger, then you are able to use this method already. Now, the third approach is actually technical based. Now, this is actually using technical analysis tool, for example, like support and resistance, chart patterns or indicators to set your stop loss level. Now, for example, let's say if you're going to enter at this point, okay, I just randomly select here, okay, at this point, you want to enter this, taking a long position. Of course, you need to measure to find out where is the nearest support level. So for example, here you identify the nearest support. So that would be your cut loss level. Now, of course, if you are using technical analysis base to do your cut loss, there are also conditions before you are able to apply this correctly. Okay, two important conditions that you must meet. Okay, number one, you must at least be proficient in technical analysis. Now, this means is that you need to have a level of competency, okay, the skill to interpret the charts meaningfully and not just drawing lines randomly. You should be able to identify the key support and resistance levels. Okay, you need to be able to draw the lines accurately and understanding the chart patterns and price structure. So if your technical analysis competency is weak or not consistent, right, your cut loss points will not be reliable, and it is also emotionally driven. So this is the first condition. The second condition is that your trading strategies will also be based on technical analysis. So here it's a combination of your trading strategy as well as your cut loss approach. So if your entire strategy is actually based on technical setups, right, then your exit rules, okay, must also include your cut loss so that it actually aligns with that logic. So whenever possible, backtest your trading strategies, include your stop loss rules to see how they perform across different market conditions. Now, this gives you data and also gives you an evidence to see whether your trading strategy works over the long run or not. Because in the previous chapter, I've already shared with you, right? Your trading strategy is actually your first level of defense. So technical based stop loss is as good as your technical understanding when you apply technical analysis. Okay, if your analysis is vague, your exit will be vague also, and that can be very costly. Another technical base is actually using technical indicators. So for example, a common indicator that we oftentimes use is simple moving average. So like this is that you can actually, at a point you enter the market, and then if you're using moving average, this moving average line can becomes your stop loss level for a long position. Okay, another example on your far left hand side, if if price above, you enter the market, and then your line would be moving average line would be your stop loss level. Now, of course, the condition of doing this is that you need to measure how far your entry point to your stop loss level. If your entry point and your stop loss level is very far, which means your risk and reward ratio might not be favorable to you. Okay, so you need to ask yourself whether you can accept the magnitude of loss. For example, if is it a loss that is within your acceptable level or not? Is it a few $100 or whether is it $1,000? Okay, if it's beyond your risk tolerance, then you can skip this particular trade. Okay, so this is technical base. So good thing about technical base of stop loss is that it aligns with your entry and exit point, so that you can actually adjust your entry and exit according to the market trends or even your price patterns or even price action strategies. Now, the drawback is that, of course, technical analysis, you need to understand what are the weaknesses of technical analysis. Technical analysis, it's not a foolproof thing, okay? Technical analysis, sometimes you will have false breakouts because some technical levels might be breached temporarily due to market volatility, and it might lead to premature exits. Sometimes technical analysis can be having complexity because it requires you to have good understanding of the technical analysis, and also you need to have the ability to interpret charts accurately. Okay, so besides that, technical analysis definitely it comes with subjectivity when you are trying to interpret your chart. So when you do this technical base of risk management, you need to backtest your approach together with your cut loss strategy. Now, the fourth method is on volatility base. Now, this is actually based on the volatility of the product that you trade. If you trade FKLI, it is based on the volatility of FKLI. If you trade FCPO, you based on the volatility of FCPO. There are many indicators or tools that can measure the market volatility, such as the average true range ATR. You can use Bollinger Bands, you can use standard deviations. And of course, due to time limitation, I am going to show you the commonly used approach, which is the ATR, the average true range method. Now, so for example, when you use the ATR indicator approach, is that you need to insert average true range indicator, which is the ATR. Most charting platform, most charting platform, they give you, you are able to insert this ATR indicator for free. Okay, you do not need to subscribe any charting software for that. Okay, because it's a common, popular indicator that is available in almost all platforms. So you need to insert an additional indicator, which is what we call as ATR. So for example, if this is your entry point, okay, 3970. So you need to look at your ATR here. What is your ATR value? Okay, if your ATR value is 72 points on that day, so you need to take 3970, okay, minus 72 points. So here you are able to calculate where is your stop loss level. So 3970 minus 72 points, your stop loss level would be 3898. So again, are you comfortable with taking 72 points of losses or not? You need to again go back to the first method, okay, dollar-based approach, whether you are comfortable with taking this kind of dollar of losses or not. All right, so some commonly used ATR like one-time ATR, 1.5 times APR, or even 2 times ATR. So good thing about volatility-based approach is that it adapts to the market conditions. It reduces premature exits, because if the market is very volatile, your ATR will also be showing a huge value. So which means you will be putting a wider stop loss. If the market is very flat and very low fluctuation, your stop loss would be very narrow as well. Okay, so these are the benefits. But the drawback is that you need to have many steps to do your calculation. All right, so same thing like the percentage approach, you need to have at least two or three steps to calculate the dollar cut loss, whether you're comfortable with it or not. And of course, during high volatile markets, if you use ATR, you need to be able to accept a wider losses, because higher volatile markets, you need to set your stop loss further if you're using this volatility approach. All right. Now, fundamental base. Now, this is especially true for those of you who like fundamental analysis, or if you incorporate fundamental analysis in your trading. Now, you can set a stop loss if there is changes in the underlying fundamentals that does not goes against that does not in favor with the direction that you are going to trade. So for example, if you're taking a long position, you expect markets to go up, and the fundamental news or data that comes out is actually showing a downtrend. So whenever you see there is a downtrend news or news that is not favorable to you, immediately you exit the market. All right. So the good thing is that it goes along with the long-term fundamentals. It's data-driven decision. Now, the challenge here is that sometimes fundamental news might not reflect the real-time changes in the market conditions, and sometimes it might also take time for the price to reflect the fundamental changes. So fundamental analysis might take some subjective interpretation as well. Okay. Now, trailing stop loss, for those of you who are quite advanced, trailing stop loss means you will be able to adjust your stop loss. And trailing stop loss, you will only use this method, especially when you have a gain. Okay, if you have a loss, never ever adjust your stop loss. Okay, now trading stop loss is actually adjusted when the price is actually moves in your favor, when you have a profit already. Now, so for example, when you enter at this particular price, you have your initial stop loss at your moving average line. So now that the market has already trend upwards, so you can actually move your stop loss a little bit higher, so that you can take a profit earlier, rather than waiting for price to come the other way around. So trailing stop loss, it has its own advantage because you are able to protect your profit, and it also adapts to favorable price movements. Now, the bad thing about trailing stop loss is that it can be very tricky, especially if the product that you trade is very volatile. So trailing stop loss, again, never ever if you want to avoid taking profit too early, right? Never ever set your trailing stop loss too narrow, because as traders we want to trade according to the trend. We want to let our profit run. Okay, so you depending on your trading strategy, you may not want to lock in profits too early in a strong trending market. So again, if you're using trailing stop loss, you need to know the disadvantage as well. And lastly, time-based strategy. Now, this one is a little bit more advanced, depending on whether you incorporate this in your strategy or not. Because of time limitation, I would want to go this a little bit faster. Now, time-based approach is that, if you enter a particular trade, you need to give it some time. Let's say if you set a rule is that after 5 days, if the market does not move, you will exit that particular trade, okay? Regardless whether you are profit or loss or not, okay? So this is actually a final approach of how you would be using a time-based approach. This is a little bit more advanced, okay? Of course, it has its own pros and cons as well. Here, I would put a less emphasis on this. Now, which cut loss method that you need to choose is that it depends all on your trading strategies, your risk tolerance, and which asset that you are trading, whether you are trading FKLI or FCPO. And you also need to look at your account size. Okay, account size dictates a lot how you are going to manage your stop loss. Now, lastly would be money management and position sizing. Now, of course, before we come into money management and position sizing, first thing to manage risk is you need to look at your trading strategies. You need to know where you're going to cut loss, and also you need to know how much money that you need to have in your trading. So I believe a majority of you are still relatively quite new in trading, right? So of course you will be starting with small trading size. So money management is actually very matters a lot, because trading isn't about making profits, it's about protecting your ability to keep trading tomorrow. So this is actually your second line of defense. So even if with a great trading strategy, right, if your poor money management, right, can also destroy your trading account, because your money management does not support your trading strategy. So when it comes to trading, we need to look holistically, not just only looking at trading strategies. You need to look at each and every area, okay? Not just only on the offense part, we also need to look at your defense. So the hard truth is that you can actually survive a bad trade with good money management. But if you cannot survive the trade if you have a bad money management, even if you have a good trading strategy. All right. Now, if you have good money management, it also means you have a good trading psychology. Now, you will have lesser fear of losses. You will not have fear of missing out. You will not doing over trading. And with a good money management, you will have more patience, more discipline, and also you are able to have longer term consistency when you apply your trading strategies. So here you can take a picture quickly to take a screenshot on the key principles of money management. So I'm going to highlight the first three items. Now, firstly, you need to accept that losing is actually part of the game. No trading strategy has 100% winning rate. Okay, you need to accept small controlled losses as part of your trading plan. Money management is not about avoiding losses, it's about controlling the damage that you lose. Okay, why? Is because expecting perfection in trading, right, can lead to a lot of emotional trading. So it's best for you to accept losses, keeps you rational and maintain professional in your trading. Now, second thing is that always risk a small percentage for your trade. So of course, just now I shared with you, 1 to 2% of your total trade, right? It's not quite applicable, because if your trading account size is small, using percentage method does not quite applicable for you. However, you still need to, have at least 2 times or even 3 times of your initial margin to trade the product that you want to trade. Okay, because if you have sufficient money for you to trade, and also limit your risk to a small amount, then you are able to survive until you are able to learn the patterns of the product, okay, the price patterns. Thirdly, you need to focus on your risk reward ratio. Now, if you only take trades where the potential reward is at least 2 times or 3 times the risk, then you can reduce a lot of risk already. So always emphasize on, again, back to your trading strategy. You need to test out your trading strategy to see whether it works or not. Because earlier I've already mentioned to you, your trading strategy is actually your first line of defense. Your trading strategy, if your strategy has a good risk reward ratio, then you can go ahead, take the trade. Okay. Now, position sizing also matters, but this is we put a little emphasis on this, because if your trading accounts is actually big, then this is where you need to place more emphasis on position sizing. But if you are still new in trading, please start with one contract first until you are comfortable and really master how to do your risk management. So in simple terms is that if the market is actually very volatile, or if you are going to take a wide stop loss, always trade a smaller position size, okay? Especially for those of you who are doing swing trading or trend trading, or if you are going to hold position for a medium term, you need to put your stop loss a little wider, and of course trade smaller positions. Whereas for those who are doing day trading, now tentatively you might want to have a tight stop loss so that you are able to trade larger position size. Okay, so this keeps your dollar risk per trade constant no matter how volatile the market. So of course, again, if you're not comfortable with trading too big, and if you are not comfortable with having, if you look at dollar terms of losses, you're not comfortable with it, please always go back to the very, the first principle of trading is always trade small. Okay, if you're comfortable with one contract, then slowly you increase to 2 contracts. If you are comfortable with 2 contracts for a period of time, then you slowly increase to 3 contracts. Okay, most people they try to keep double up each and every time when they see they have a profit, and that is actually a very a bad practice to do in trading. So a common mistake to avoid in position sizing is that don't risk too much on high conviction trades. Now I understand that sometimes when you test your trading strategies, right, you might be very confident that a particular trading strategy or trading setup gives you a very best opportunity, and you want to put a very big bet on that. So try to avoid on this as well, because again, position sizing, because you're trading futures, it comes with leverage. So always we want to emphasize on the safety part first. Never ever trade too big. Okay. Secondly, never ever adjust your size of your stop loss distance. When you set your stop loss, just stick to it. Don't adjust your stop loss. And when you lose money in your trading, right, especially when you have 1 losses, 2 losses, or multiple losses, please don't increase your size, because doing reverse trading would, again, you are already violating rule number 1 already, right? Taking too much risk. All right, so the first 3 things is the most important thing for you to do. Okay, and when you're able to focus on the first 3 parts, the subsequent thing is that you are able to follow those rules accordingly. So here I'm going to highlight a few key principles of position sizing. So of course, your number 1, your risk per trade must be predefined. Before you even thinking about entering a trade, you must know how much dollar risk that you are going to take. Then you adjust your position sizing accordingly. Now, if you're just only trading 1 contract, right, and you see that you are not able to accept that dollar losses, now one thing that you can do is that don't trade at all, okay? Or you need to increase your trading capital so that you're able to absorb the losses. Now, secondly is that your trading size must be linked to the distance of your stop loss. If your stop loss is actually very far apart, then you need to trade smaller. If your stop loss is actually very tight, then you can actually trade more positions. Okay, so this is actually very simple on it. And number three, volatility, again, it dictates your sizing. High volatile markets, you need to have wider stops with a small trading position. If the market is actually having low volatility, you can actually take tighter stops or narrow stops, but while at the same time you can trade larger positions. But of course, the safe part is always trade smaller positions so that you don't risk certain moves in the market can, low volatility can turn into high volatility. All right, so these are the things that I would want to highlight to you. And lastly, number 7, I will skip a few things. Number 7, your position size should never ever expose you to any huge losses that can completely wipe you out from trading. Okay, so I understand that sometimes you might your trading capital might be having let's say you have 20,000, 50,000 in as a trading capital, and you can trade many contracts, right? But again, please start with a few contracts, especially start with one contract first, so that you're comfortable with it, you master each and every area, then only you slowly increase your trading size. Now, here are some popular quotes on managing losses. If you look at all of those famous traders, is that they emphasize on trading, managing risk. Okay, if you read all of their autobiography, all of their stories, they often share about how they manage their risk. Very seldom you hear them saying that they share their any of their trading strategies, but they do always share that they manage their losses. So all great traders, good traders, they are a professional risk manager. Now, one last few things before I end is that how much capital you need in your trading account is that, of course, the more sufficient capital, it's better for you to trade. But of course, trade less, never ever undercapitalize your trading. Because if you just don't have sufficient money to buffer your losses, right? Please don't trade at all. What you can do is do your paper trading to familiarize the market and also to polish your trading strategies. Don't trade with scared money because especially money that you can't afford to lose, because if you trade with scared money, by default, you are already putting yourself at a disadvantage. Okay, if you can't risk it, don't trade. And lastly, how many positions to trade? Now, it depends on how much you have in your trading account. Okay, if you don't have so much buffer in your trading account, start from small first. It also depends on your trading strategy, just like the picture, the arrow and the target that I share with you. Just because you have a lot of money in your trading account does not mean that you can simply aim and simply shoot. Always start small, always polish your skills first, then only you increase your position, okay? Now, let me conclude. Today's takeaway here is that you need to understand the risk of futures trading and always be thinking about risk by using a risk-based thinking. Trading strategy is always your first line of defense to minimize your risk. You need to get your entries right first. You need to test your strategies before you trade with real money. And you have 7 ways for you to cut loss. You don't have to use each and everything of them. You can start with fixed dollar cut loss or even technical base cut loss first. These are the two commonly used, but try to be consistent in your trading first. Don't keep switching different ways of cut loss. First, master one cut loss until you are familiarized cut losses without having any hesitation. Then you can begin to explore another approach of setting cut loss. And last thing on risk management is that money management and position sizing is also part of your risk management. So these two things also matters a lot. All right, so that's it that I have to share for you for today's topic on risk management. Hopefully you learn you have a different kind of mentality when it comes to managing your trading risk, in managing how you trade or how you do your futures trading. All right. Now, before we enter our Q&A session, if you have any questions related to today's webinar topic, please type your questions in Slido so that I can easily capture your question and address them. And while we're waiting for questions to come in, I would like to ask a small favor from all of you. Please take a minute to fill out this feedback form. Since we provide an informative session for today, it will take you less than a minute to complete this form. So it's important for us because so that we are able to improve our future sessions to ensure that we deliver high quality content tailored to your learning needs. So please take a quick minute to complete the form, and we will begin the Q&A shortly. Another 30 minutes to go. Another 30 seconds to go. All right, a minute has passed. If you have already submitted your feedback, thank you very much. If you're still completing it, feel free to continue. And let's move on to the Q&A session. I see there are several interesting questions and good question here. Now, the first question is that how to avoid the risk of getting margin call. I understand that for new futures trader, right, margin call can be a frustrating thing, right? The last thing that when you trade futures is the last thing that you wanted is actually your brokers to call you to top up your trading account. Now, how to avoid getting margin call is that number one, again, you need to manage your risk. You need to have sufficient money in your trading account, a good enough buffer for you to do your trading, because oftentimes for traders that easily trigger margin call is that they have too little buffer in their trading account. So even when they trade one contract, right, when they have losses, it's very easily get triggered margin call. So which is why margin call can get triggered easily. So in order to avoid margin call is that, a very good general rule of thumb is that you need to, depending on what product you trade, you need to have at least 2 times of your initial margin, okay, to trade that product. Okay, 2 times of initial margin to trade that product. So for example, if you're trading FKLI, you need to have at least 2 times initial margin, FKLI initial margin, to trade one contract of FKLI. If you're trading FCPO, you prepare 2 times of initial margin for FCPO to trade one contract in FCPO. Now, of course, we haven't looked into trading strategies yet, but at least when you have sufficient capital in your trading account, this is the first thing that you can avoid getting margin call. Now, second thing is that you need to look is actually your trading strategies, because again, trading strategies is your first line of defense. If you are keeping, having a wrong entry, you have to keep cutting losses, your trading account keep losing money very quickly, you will again trigger, your account falls below the required margin, and then you get margin call triggered again. Okay, so this is at least 2 ways how you can avoid getting margin call. Now, the next question, if we can't use 2% rule, can we increase it to 3%? Now, yes, of course, we can use 3%. Even if you want to use 1%, that's fine as well. But again, if we use percentage base to calculate your stop loss, you need to convert the 2% of your trading account back to dollar amount. Okay, so there is at least a 2-step approach. Okay, you need to convert the percentage into dollar amount, and that dollar amount, if one contract, are you comfortable with, are you willing to take a losses based on one contract for that amount or not? If you're not comfortable with that, even for 2%, 3%, then this cut loss method is definitely not suitable for you, then you need to change approach. For example, using the number one approach, a fixed dollar amount, or at least used technical method approach to do your cut loss, because using percentage rule, oftentimes it's more applicable for those huge account, okay, or any other trading instruments that can go below one contract, because here we're trading futures contract, right? So the minimal amount of contract is actually one contract. So you need to have a realistic expectation on that. The next question, is there a platform for FCPO with auto trailing stop loss or not? I believe there is a platform for that, but however, most standard platform, right, we may not have auto trailing stop loss. Most platform, you can do a normal standard stop loss, which is, you can execute it using limit order, market order, or even using stop orders. Okay, so if you want to use a trading stop loss, probably you need to have an advanced platform. So oftentimes advanced platform means you need to subscribe and pay a little bit fee in order to use those advanced features. Okay, so I would encourage you to, for those of you who intend to use auto trailing stop loss, first you need to be comfortable with doing it manually first. When you're okay with cutting losses manually, no matter how big the losses, then I believe you are okay with doing trailing stop losses. Now, next question. As a beginner, which cut loss method should I start with? Now, for beginners, to make things simple, is that you can start with fixed dollar amount of cutting losses, because this is the most easiest way for you to practice cut loss, and also for you to calculate at which level you need to cut loss and get out of the market. Because for beginners, your objective of trading is to learning how to do your cut loss, protect yourself so that you are able to preserve your capital. So you need to keep your trading as simple as possible first, until and unless you are able to survive in the market. You polish your trading setup, you polish your trading strategies, then only you can advance to different ways of cut loss. Another question also related to stop loss. Which stop loss suitable for FCPO capital below 20,000? Now for 20,000, of course, the easiest way is using a fixed dollar. Now, of course, I am not quite sure which or what trading strategies that you will be looking at. So regardless of what strategies that you trade, again, no matter, just now I've already shared 7 ways of cut loss, right? All of those 7 methods, it all boils down to the dollar amount, how much you are willing to take your losses, because that is the most easiest approach for you to do your calculation, right? So you can start with fixed dollar amount. Next question, how much capital should I prepare as a beginner? Now for beginner, earlier I have already shared in money management, you, depending on what product that you will be trading, you need to prepare at least 2 times, that is the basic requirement, 2 times of initial capital of the product that you are going to trade. Okay, and from there you can start with 1 contract and then slowly polish up your trading strategies. Okay, I see there are several few more questions here before I conclude the session. Now, another one, how to backtest your trading strategies. Now, I believe in YouTube or even GPT, there are plenty of resources here. You can do your backtest your trading strategy. Now, here, the simple way to backtest your strategy is that you need to find out what is your look at least your chart. 3 years, you need to first define your trading strategy clearly first. Okay, then look across for the past 3 years, where is the entry point, where is the exit point. record all of those entry and exit and also the cut loss level to see, over these 3 years, whether this particular trading strategy is having a profit or a loss. In what situation does it profit? In what situation it is having a losses. So this is where when you are able to backtest your strategy, eventually you will slowly notice, the pros and cons of your trading strategy. You begin to understand the characteristics of your trading strategy. Another question, how to play stop loss when re-entering trade after pullback, day trading FCPO on 15-minute time frame. How to play stop loss when re-entering trade after pullback. Now, if you are re-entering trade after pullback, right, you need to treat it as a new trade as well. Okay, so it doesn't really matter what kind of time frame that you trade. Okay, it all boils down back to your trading strategies. If you are having a good trading strategies, then your stop loss should be maintained quite consistent across that particular strategy for that specific time frame. Okay, another 2 more last questions. I'm sorry that time is a little running late. Now, normally, what kind of stop loss to use when we scalp the market? Now, scalping is actually a very fast trading approach. So it depends on how long you want to scalp the market and even hold your positions. So oftentimes, I do not know what kind of scalping strategy that you use, but because we are scalping the market, it's a very fast in, fast out method. So to do that is the stop loss usually will be actually very, very narrow. Some traders, they might put 2-3 points as a cut loss to scalping. Some might put even 10 points as a scalping. So again, it depends on your trading strategies. One last question is that when calculating risk and reward, do I need to add on fees at the platform? Some is spread, some is actually fixed percentage. Now, of course, to make it simple, when you're calculating your risk and reward, yes, it would be good when you also including transaction fees to see whether your trading strategies work or not. Now, just a quick note is that some trading strategies, it works very well under assumption that there is no trading fee into the calculation, okay? Which means you can do a lot of trades and the trading strategy, you backtest the trading strategy, it shows a profitable result. But when you calculate including the brokerage fee, all those transaction costs, some strategies you might notice that when you include transaction costs, it might not seem profitable at all. So again, we want to see whether a strategy is profitable over the long run. Yes, it would be a good idea to also incorporate transaction costs into your backtesting as well, so that you know whether your trading strategy it's applicable for the amount of transaction cost or whatever fee that you're using doing in your trading. All right, so I think there is no question here on Slido here. So it seems like today we have covered quite a lot of questions. Now, once again, I would like to take a moment to remind you about our upcoming webinars, especially for those who may have missed the earlier announcement. This LOF Let's Learn webinar series features a variety of topics every Tuesday evening from 8:30 to 10 p.m. with different languages. So next Tuesday, we'll be covering the fundamentals of FCPO and also the market outlook for FCPO, because when you trade FCPO, you don't just looking at palm oil, right? You need to look at the overall, the global vegetable oil. So if you're interested in understanding the FCPO fundamentals, please register for our next week upcoming session. So once you scan the QR code, you will be directed to a page where you can access to our event calendar. So all you need to do is navigate to the Tuesday column on our event calendar, click on the sessions that you are interested in and proceed with your registration accordingly. Now, in addition to our webinars, we also have the LOF online workshop. Now, this workshop is tailored for those who are still very new in futures market. And if you're interested in learning about futures trading in detail, then this workshop is ideal for you. So you can take a picture or screenshot this page, register yourself after this webinar ends, and feel free to share this event with your friends and family. We will guide you step by step on how to start your first futures contract. And of course, please note that each session is limited to the first 50 online attendees. So be sure to register yourself quickly to secure your seat in both workshops. So if you want to find out where is the online workshop, you can go to our event calendar, look for them in the Saturday column. Click on the workshop session that you are interested in and proceed with your registration from there. Now, for those of you who may not already know, Bursa also have this derivative trading simulator in Bursa Marketplace. So this is a simulator that allows you to engage in paper trading. So this is actually also another way for you to practice risk management and also familiarize yourself in using a futures trading platform. So you can register for a risk-free trading experience, give it a try to start developing your interest in futures trading, learn to practice how to execute order correctly, practice your trading strategies, practice how to do your cut loss, so that you are able to have a hands-on experience through this trading simulator. And finally, before we conclude this webinar, allow me to introduce this Bursa Academy. Now, Bursa Academy is a comprehensive one-stop e-learning platform where you can access all the information and knowledge about stocks, futures, and other products traded on Bursa Malaysia. So you can scan this Bursa Academy or even scan this QR code on your right or search Bursa Academy on Google to find the link. So you can visit this site for more detailed information and resources. And for the past LLF webinar video may be uploaded in this Bursa Academy as well. So it's a valuable resource for you to enhance your understanding in trading in Bursa Malaysia. So, all right, we have come to at the end of our webinar session for today. So to all of you who joined us, thank you for your participation. I hope you found this webinar both informative and valuable, and I believe you have gained some new knowledge and perspective how you can manage your risk, and especially how you can have a better and good mindset about risk management, because risk management, it really starts with your mindset. Then techniques, methods come second. All right, so with that, I'm CY signing off for now, and enjoy the rest of your night. Have a good evening, and until next time, bye bye.